guys, you're welcome back to my YouTube channel. If you're new to this channel, don't forget to hit the subscribe button and turn on the notification bell to get notified whenever I drop a new video. On this channel, I teach strategies, different financial market strategies that will make you profitable in the financial market and you can use in your day-to-day activities in the financial market. I'm going to be doing some series and this is the first one, and the name of the series is Unlocking Forex Hidden Gems, okay, and how to use them. You know, some people just know that there are some things in the Forex market or in the financial space, but they don't even know their use. They don't know what they need to use them for. So I'm going to be teaching you guys different things we can use different forex gems for, and this is the first video I'm going to be making about that. And in this video I want to show you how to use Fibonacci retracement. I want to show you how to use it. You see, there has been a lot of misconception about Fibonacci retracement and how to use it or how to make use of the Fibonacci, and then it is making a lot of people think Fibonacci no longer works. I'm going to blow your mind with this video, guys, so just stay tuned to the end so that you can use this particular thing in your day-to-day activities. Personally, I used it and it has been of help so far. So I'm going to be teaching you how to use it. I'm going to be showing you the settings and I'm going to be showing you what you need to use Fibonacci for. Okay, so let's get straight into it. The first thing you would want to do is to make your settings. You have to get your settings right, because in the Fibonacci, when you get to see the settings, the first settings in the market, when you see the first settings, it might not make a lot of sense to you because there are a lot of things that came with the Fibonacci. So you just have to put the settings to your own taste. You have to set it to your own taste so that you can know what you are using it for. So I'm going to show you guys the settings first, and then I'm going to show you how to use it. So this is the Fibonacci. So let me show you my settings. So this is my settings, right? This is my settings. I have 0, I have 0.5 turned on, and then I have 1 turned on. You can see that I turned off every other things. I turned every other things off. If I turned everything here on, you are going to see that this place will be overcrowded. There is going to be a lot of information for this Fibonacci, but I don't want it to be that way. So this is the settings I'm going to be using, and this is the settings I'm going to be teaching you guys. So once you get the settings, the next thing you would want to do is to proceed to how to use Fibonacci. Now, what do you use Fibonacci from? The first thing I use Fibonacci for is to recognize my premium and discounts. Maybe for a particular range, I want to recognize the premium area and I want to see the discount level where I can seek to buy the market. When we talk about the premium levels are areas where market has really bought to, and then you are seeking to sell from that point. While the discount area, just like the normal thing we hear people say, I'm offering a discount, I'm doing this, it is the lowest area where you are seeking to buy the market. Now, for you to be able to use this Fibonacci retracement, you have to learn about swing points. You have to know your range, and then you have to know the structure of the market you want to use it for. If you don't know the structure, it's going to be difficult for you to use the Fibonacci because you won't be able to flow with the trend. So I'm going to advise that you learn more about structure, learn how structure works, and then this is going to be an added advantage for you. So when you learn about structure, you learn your range from a swing point to another swing point. You need to learn swing points, where swing points are. I'm going to be teaching you all of this in this video. Then another thing I use Fibonacci for is to recognize my premium and discounts at a PO high. You know, you can just mark out a PO high and then you are expecting market to use the week of the PO high for a continuation. Meanwhile, market is going to dip inside more. So I'm going to show you how to use Fibonacci at your point of interest in recognizing your discount or premium level, or your 50% level. Yes, your 50% level, which is the equilibrium. I'm going to show you all of this. So once you've done your settings, the next thing you want to do is recognizing your structure and recognizing your swing point for that structure. So we have two types of structure, as you all know. We have the uptrend and then we have the downtrend. This is volatility 25. You can use this Fibonacci settings for currency pair. You can use it for crypto. You can use it for the synthetic markets. It has wide opportunities. It has wide opportunities. Okay, guys, so let's get into it. I'm going to be using volatility 25. So this is an uptrend, clearly seen from this perspective. This is daily time frame. So the market has been trending to the upside. So how do you recognize your swing point? Let's talk about swing points first before we talk about range. Now, swing points are significant area of the market where we have a continuation or we have a reversal. They are significant places of the market where the market did a significant continuation or a significant pullback. So for instance, we have this pullback to the downside. This is a significant high for the market to pull back. So this is a swing point here. We have our swing point here. Now, if you are confused on recognizing your swing point, I'm going to advise that you use fractals. Fractals indicator. It's part of your indicator. So if you don't know the use of fractals, I am also going to be unlocking the gem of fractals, so you don't have anything to worry about. But right now, let's talk about swing points. So this is a significant area of the market. You can see this is a significant pullback, and this was the high that's made for this pullback. So this is a significant high, and so it is our swing point. This is another significant low for a continuation to the upside. So this is another swing point. This is also a significant pullback. This is a significant high. So we have another swing point here. There is another swing point. We have swing points. You can see swing points all over the market, but in as much as you are seeing your swing point, you have to recognize the range. Recognize the range you are going in the market, or that the market is currently. And for you to recognize the range, there are two things you have to look out for. You have to look out for the structure, the break of structure, the movement, and then the second thing you have to look out for is where is your liquidity area? Where do you think the market is going to use as a liquidity based on what you've learned so far? So let's get into it. We have our break of structure to the upside here. This is a break of structure to the upside from this swing point. So after this break of structure, we already recognize that our structure. So the next thing we would want to recognize is where is the liquidity area. You have to put all of these things into consideration. You see, Fibonacci is not just something you can use on its own. It is dependent on some other factors, which includes the structure, and it also includes liquidity. So you have to know all of these things regardless of anything. You have to learn about these things. I have had a couple of videos on my YouTube channel, so you can check them out. You can check out for structure, you can check out for seeing your liquidity. So you can see that we have our break of structure here. So after the break of structure, you can decide to use your Fibonacci for this particular high to when you start having your reversal, when you start having your significant pullback. So from this low to when you start having your significant pullback, that is your range. From this range to this, from this low to this high, that is your swing point. So we are in between this range. This is a range here. So let's pick our Fibonacci and see what the market did. So from this low to this high. Now, it simply means unless market comes into this discount level, you are not seeking to buy. You are not seeking to buy until market comes to your discount level. It simply means when market stops around this area and it continues for you buy, It simply means you will use that low as your liquidity point. Guys, this is really mind-blowing. It simply means when markets just reverse at this premium level and it starts going up, let's assume we don't have this low. It is only this low we have here. You can see that the low did not even get to the 50%. The low hasn't gotten to the 50% before it starts moving to the upside. It simply means you are saying that, oh, I'm not taking any trade unless we come into our discount level. Remember, we are seeking to buy at discount level, and we are seeking to sell at our premium level. That's in a downtrend. Now, equilibrium simply means that is where premium and discount meet. Equilibrium is still okay. Anything from the equilibrium to the discount, you can seek for a buy continuation in an uptrend. Then anything equilibrium to premium, you can seek for your sell move. Okay, you can seek for your sell move in a downtrend. Now, this is an uptrend right here from this particular swing point, this low to this swing high. Then we're expecting market to come back into our 50% or into our discount level, and that is where we're going to be marking out our points of interest. That is where we are marking out our point of interest. And you can see from this swing high to this, from this swing low to this swing high, the market came back to discounts. Market came back to discounts here. You can see our market came back to discount and then it used the PO high at discount for a continuation. Now, let's just assume that, okay, this low is not our liquidity here because we've not gotten into our proper sponsored candle. But regardless, the market used it for a continuation. So let's assume that we say this is a break of structure. Remember, this is an assumption because we are marking this low out as liquidity. If you've checked out my video, you will know why we are marking this low out as inducement. After our break of structure, this is the next low we have, and that is why it is our inducement. But we have this to the upside. We have this movement to the upside. So if you are a scalper and then you just feel, oh, I want to continue in the buy, I just want to get a little buy, then you can pick out your Fibonacci from this swing point to this swing point, which is the range. Then you are waiting for the market to get to your discount level. You can see that when markets got to 50% here, we had a good reversal to the upside to create a higher low. The market make a good reversal to the upside to create us a higher low. You can see we had a very good reaction at that equilibrium, and it was already at discounts. Markets did this at discounts, but for the fact that we want to come back and pick out our liquidity, the market just had to come back all the way down to this place. So how do you mark out your premium and discount for points of interest? Let's get into it now. I've explained about range, I've explained about the swing point. So let's assume this is not assumption now, this is actually our sponsored candle. This is our sponsored candle here. And you don't know where the market might choose for a continuation. And you want to see how the market will get there. I'm going to show you some things here. And you want to see how market is going to use. Now, I'm going to advise that you wait for market to get your equilibrium. Don't just put your buy limit at the week. Don't put your buy limit at the week, because most times markets will dip inside 50% of that order block or of that sponsored candle or of your PO high, that level of PO high, that area of interest. The market will dip 50% before a continuation. So the next thing you will do, if you've marked out your point of interest, just pick out your Fibonacci, just bring it here. After your Fibonacci, you just bring it here. And then you mark out your 50%. So this is our 50% here. This is where the 50% is. You can see this is your 50%. You're expecting market to come into this 50% or enter into your discount level, and then you look for a buy. You can see that this particular low did not get into our discount level, and we created a liquidity for this range. That was why market did not come back to this level to come into our sponsored candle. But let's see for other places. We have our BMS to the upside here, and you now know your range. Since we have our BMS to the upside, so where are the significant areas of the market? This is a significant area of the market. This is a significant low. Now, when market starts making a significant pullback, that is when you will bring out your Fibonacci to seek for 50%. Ensure the market has started the pullback. Ensure market has started the pullback. That is how you are going to weigh how far the pullback will go. Ensure you have started seeing that pullback, that intent that we want to go for a pullback. So let's see, we have from this swing high, from this swing low to this swing high. So from this 50% downward is our discount. So we're going to be looking for a very good PO high around this discount level. Ensure you are not buying from here. No matter what you see here, you can see how market deceived a lot of people in here. We had this short-term BMS to the upside, which is actually a liquidity, and people will see to want to continue the buy from this place. But as you can see, we are inside a premium. We are still inside a premium. So you shouldn't even be looking for a buy around here. So you wait for the market to get to your discount level, mark out your liquidity area. All these things works together. Ensure that you are using your Fibonacci. Now let's use Fibonacci for this PO high. Let's use our Fibonacci for this PO high. All right, this is how it's supposed to be marked because this is an area of interest. All right, market almost used our 50% here for a continuation to the upside. I'm going to zoom that in. Market almost used this 50% area of interest. Now, the reason I'm not going to mark out just this other block is because if you check out on your weekly time frame, all of this area are actually sponsored candle. All of this area, they are actually sponsored candle. Assuming we have our weekly time frame here, I would have shown you on the weekly time frame, but you can check it on your own also. All these areas are actually sponsored candle. For us to refine it is when we bring it down to this candle. So I'm marking from this high to this low as my area of interest. So you can see market almost used this 50% for a continuation. But we did not get into that 50%. So let me mark it out clearly here and see if we actually got there. All right, guys, you can see market used exactly 50%. Market used exactly 50% for this particular range. For this particular range. Now, this is an impulse to the upside. This is an impulse to the upside that signify that the big guys have stepped into the market. This is an impulse to the upside. So breaking this high from this high to this low is actually our order block, our sponsored candle here. And you can see what the market did. The market used 50% for a continuation. Immediately you see this impulse movement to the upside, you already know the big guys have stepped into the market. So what will you do? You mark out your minor break of structure to the upside here, and then you are waiting for the market to come back into your 50%. And you can see it's used exactly 50% for a continuation to the upside. Now, the reason market came back to this area is because this low is an inducement after we've broken our normal structure to the upside. This low is an inducement, and that was why market came back here. If not, market had no reason to come back to this area, but this is our inducement level, and you can see how market used that place. So what else do you want to do again? So we have another movement to the upside here. So let's assume that we have from this low to this high when market started making our significant pullback. So we're going to mark it this way. We're going to mark it this way from this high, from this low to this high. Market started making a significant pullback here, an intent that it wants to go back into your PO high. And you can see this is a movement to the upside. Market came back into our discount level. Our market used our breaker block here. The market used the breaker block for a continuation. Market used our breaker for a continuation. You can check my video on PO high also. Market used that breaker for a continuation. So let's assume we want to mark out our PO high here. Basically, we are going to be marking out this area. This is our area of interest. From this low to this area of interest. This is our area of interest. And what did the market do? The market did not come back into the equilibrium and it did not get to the discounts. But I know you understand what I mean. Now, if market breaks this high and then you are expecting a pullback and market is making a very deep pullback, you are expecting it inside this area because this our area of interest has not been properly tested. It has not been properly tested. So you're expecting a pullback into this area. Even if market is not going to hold, market is not going to use this area of interest to hold market. The market will react heavily here. And this is the area where you can hedge the market just to give you that small pullback. You know, scalpers, you can just edge the market to give you that small pullback and then you continue to the downside based on the structure. Let's check another of our assets and see how far we can see with Fibonacci. So let's check another asset. Let's check volatility 25-1S. Let's look at another pair, which is volatility 25-1S. Okay, so let's do the same thing over and over again. I told you guys that it is based on structure. We work based on structure. So the first thing you would want to do is that you look out for your last break of structure, and then you are going to get your range. And to get your range, you're going to work with swing to swing point. So we have our last break of structure here, guys. So we have our last break of structure. Now, after our last break of structure, we are going to be marking out our significant pullback, and you can see that we have our significant pullback. So we'll bring out our Fibonacci, and then we're going to mark from this low to this high. From this low to this high. Now, the next thing you would want to do is to pick out your reasonable PO high inside the discount level. Now, based on this movement to the upside, this impulse to the upside, we have a lot of distance. Market might not be coming back into our primary zone of interest, but I'm going to be marking out that primary zone of interest. So let me mark out this primary zone of interest. So after marking out the primary zone of interest, I'm going to bring out my Fibonacci. Then I'm going to work this way. Then mark out the 50%. So let's mark out the 50% for our sponsored candle. So after doing this, I'm going to mark out my secondary point of interest. You can see I've marked out the primary point of interest, 50% that I am looking towards. So the next thing I would want to do is to mark out my secondary point of interest. So from this eye, let's mark out the secondary point of interest. So if you've not watched my video on PO, I just check it out, guys. So I'm going to be marking out the 50% of my secondary point of interest. 50%. See this clearly, guys. We're almost at the 50%. We're almost at that equilibrium. So what's the next thing you would want to do? You just analyze your continuation. You will analyze the break of structure you have here. So we have our break of structure here. Let me mark this out. Let me mark this to this stage. So you have your minor break of structure to the upside here. This is your minor break of structure to the upside. You mark that out. Ensure that you are working with structure, guys. Ensure you are always working with structure. Now, after I've marked out my break of structure to the upside, so what's the next thing? I'll mark out my PO high for this particular structure. So where is my PO high? My PO high is this sponsored candle, this particular sponsored candle. So I'm going to be marking it out, and I'm going to do the same process. Remember, the same process, I'm going to be looking out for my 50% equilibrium or at my discount level. So let me mark out the 50% equilibrium or discount level. So let's do that. We have this. Now this is my PO high around here. Let me see. All of this area, no, all of this area are actually not sponsored candle. This is 24 hours time frame. So let's see, we've not gotten into our secondary, we've not gotten into our discount level. The market just stopped at a particular point here, but we can have our continuation to the upside. But you can see how far we've gone, guys. So this is going to be the end of this Forex hidden gem for Fibonacci. You can use it on lower time frame. It works perfectly on lower time frame. So make use of it more on lower time frame. This is 24 hours time frame. We can be seeing some skip because we have impulses on the higher time frame. So you can just check and backtest it on your lower time frame, and I'm sure it's going to definitely work out. All right, guys, keep living in the atmosphere of profit. Bye, guys.